I mean, we continue to use this mantra, walk, don't run. I think you've referenced that earlier. I think that's probably been the right call. I mean, ultimately, the Fed's got two issues on the inflation front. One is rental incomes or owner's equivalent rent. That's about a third of the CPI. And the second is wages. And, our data would suggest that those are going to stay stickier for longer. And so we've had a view that services inflation would stay higher well into 2023. I think at this point, we've gone from kind of dovish during the summer to hawkish this month. I think we need to find the balance in the middle. I mean, ultimately, we are seeing the impacts of higher rates on activities like housing, and I think that cyclical slowdown will start to show up in 2023. So if I put on my central bank hat, I would say let's not only look at labor, which Chairman Powell referenced, because that's a potentially a lagging indicator, and let's also look at credit spreads and dollar, as you mentioned, and financial conditions. And they would pretend that we'll probably have some sense of slowing going into 2023.
It would seem to make sense, right? That they know that their policy acts, with a delay. You've seen what the markets have done in terms of tightening financial conditions, but they seem so hypersensitive to the idea that markets would take any hint and undo some of that. Is that well grounded?
I think we're in an unprecedented period, at least since the 1970s, where inflation's the absolute level is so high, and we haven't seen the trajectory starting to come down. So I think that they had to send a stern message. I do think it's going to take hold. I mean, we've been living in a world where there hasn't been any alternative to cash, and now cash is probably going to yield 4 or 5%, and you're starting to see that with investors moving around. I think at this time, we said walk, don't run, but there's some pretty interesting opportunities emerging. I mean, if you have the ability to go into shorter duration fixed income, that looks very interesting to us. Credit is interesting. We've been pounding the table since it's 2020 on the real assets, particularly infrastructure, real estate credit. There are things to do, and I would say even in our private equity, we're not as active right now, but the market is setting up for probably a more active 2023, where you see corporate carve-outs, public to privates, and there are going to be a lot of growth companies that were funding themselves at incredibly low rates, where I think they'll see or have to come to market to raise capital, and hopefully we can be a good partner to them too.